Good morning. It's Jeffrey Christian of CPM Group. It's about 10:10 in the morning in New York on Friday, the 21st of January. I wanted to talk today a little bit about what's been happening in the markets. The prices of gold and silver, platinum, palladium, and oil and copper and other things have been going up. Talk about what has happened and what we expect to happen next. And then I also will talk a little bit about turning off your computer, your phone before you record. Then I'll talk a little bit about some of our trade recommendations. We're making some improvements in that program. And I'll talk a little bit about inflation. And I'm actually going to start by talking about inflation because in terms of our market outlook, one of the things that we're seeing is the financial markets are really focusing on inflation and interest rates at this time. And there are a lot of expectations that inflation will remain high and will rise further. We continue to think that we've seen the highest rates of inflation last year, and that 2022 will see lower inflation figures in terms of percentages. We're not saying that prices are going to fall, but we think that price increases will not be as steep this year as they were last year in percentage terms or in dollar terms. Now, that's our view. Inflation concerns continue to rise, not only in the United States, but in most parts of the world. And inflation may well plateau and percentage change increases could actually decline, but the market's perceptions are most likely to lag any actual changes in inflation trends, which is common. And so inflation is probably going to continue to stay important in a lot of investors' minds, at least during the first half of this year. By the second half of this year, that may not be the case. Inflation may seem less problematic, in addition to which other issues like political friction within the United States, political frictions within Europe, political frictions between the United States and Europe and Russia, political frictions between the United States and Europe and China. Other issues may be commanding more attention on the part of investors. All pretty much positive for gold and silver investment demand and prices. So right now we're looking at inflation, the market's looking at inflation, the market's looking at interest rates. Interest rates have shot up over the last couple of weeks. They're actually coming off a little bit in terms of US Treasuries. What we've really seen is a lot of volatility. We've seen increased volatility in interest rates, inflation data, stock markets, bond markets. A lot of folk are actually liquidating their bond market positions because they see the period of low interest rates coming to an end and they expect interest rates to rise. So they're looking for bond prices to start falling and they're getting out of that bond market. Political friction, I already mentioned. Supply chain issues remain a problem and they could be further exacerbated. You know, the zero COVID policy in China, which is really sort of the industrial hub of the world, manufacturing hub of the world, continues to put risks of further supply constraints, which could have inflationary issues. People talk about the dollar plunging, but if you look at the dollar, either against the euro or the pound or the yen, or on a trade-weighted basis, the way we do, you see that the dollar actually is increased in volatility, but it's fluctuating up and down. So you're seeing increased volatility across asset markets. Investors are increasingly questioning where we're going to be going in terms of an over-economy. And in that kind of environment, we've seen gold and silver prices rise. And I'll show you some charts in a second about the fact that basically gold and silver prices have gotten to where we thought they would in February and March in January. And if all of these headlines persist, gold could rise a little bit further. We wouldn't be surprised to see 1865 or 1880 or even higher on a temporary basis. Our expectation is still that the gold price will stay strong in the first half of this year, weaken somewhat in the second half of this year, and be up slightly on an annual average basis over the full year, with stronger prices later when some of these issues become more problematic. We're somewhat more pessimistic on silver. We have seen silver prices rise. They were $22 in early January. They got up to 24.80 or 24.75. Our target for February and March was that we thought the price could get up to 24.80, and it basically got there this week. We think that silver prices will probably be a little bit more weak than gold prices. There is no 800 million ounce short in the market that's going to explode. It's possible that prices will come back down over the course of this year. We're looking at a low of 2150 or so, and we're looking at a high possibly no more than 26, with the possibility of spikes up to 28, but probably not much more than that in 2022 for silver. So that's where we think the market is. We're looking at seasonal strength in the first quarter of this year. It's not unusual. And we're looking at relatively modest increases in gold and silver prices. Now, CPM Group produces trade recommendations on gold and silver. These are short-term trade recommendations. We have projections that go out 1 month, 3 months, 2 years, 10 years. In Platinum Group Metals, we're taking our projections of supply, demand, and price out to 2050 right now. But the trade recommendations tend to be very short, like 1 week or 2 weeks. And we say, this is where we think the markets are going. A couple of weeks ago, when the gold price was looking strong and silver prices were looking strong, we said, well, we think that these prices are likely to fall back to their short-term ranges. They didn't fall back. In fact, they moved up, and they broke out of those short-term ranges and moved to higher levels. We issued trade recommendations yesterday saying for gold that we thought that it still had some upward bias, and it could get up to 1865 over the course of the next week or two into the end of January. February is an active COMEX traded month. There'll be some upward pressure on prices as 18 million ounces of February open interest that was still outstanding as of Wednesday gets rolled into April. Silver, we actually issued a sell recommendation because we think the price of 24.65 or whatever it was at the time that we issued a trade recommendation yesterday, we think the silver price could come back off, and it has a little bit this morning. Now, we're modifying our trade recommendations. Before I talk about what we're doing, these are our 3-month price projections that we publish every month, updated in our Precious Metals Advisory. Now, Precious Metals Advisory, the January issue was 44 pages long. It covers gold, silver, platinum, palladium, rhodium, and it talks about what we see going on in the world that's going to be affecting these prices. And we have these charts every month where we say this is what we think the range of prices is going to be over the next month, and this is what the range of prices is going to be over the next 3 months. And we publish these. These were from the January 7th Precious Metals Advisory. And you can see that for gold, we thought, well, 1825 might be a high in January, but it could get up to 1850 in February or March. And I think it got up to 1849 or something like that this week. So markets moved a little bit ahead of where we thought it was. We did think that there was some upward momentum that you'd see in the first quarter for a variety of reasons, including the seasonality of demand. And the market has moved ahead of us, primarily, I think, because of those inflation concerns. Silver, we thought that the price might get up to 2370 or so this month, and we were looking at 2480 as a high possible in February and March. Got there, and it's come back off a little bit. And as you can see, we're still looking at a higher low for February and March than we were expecting as a possibility in January. So these incorporate the nuanced analyses that we put to the market and to the economic environment. And it's a very detailed analysis that we put forward. Distilling this into a short-term price projection and anticipating what could happen in the next 5 to 10 trading days is a very difficult process. But we do it. We do it because people want it. We have the trade recommendations on gold and silver right now. We will make trade recommendations on other assets like platinum, palladium, copper, and oil, petroleum. What we're doing for our clients is we're adding to the trade recommendations some commentary about where we think the market's going to be over the next month and over the next 3 months. So the trade recommendations going forward will say, well, this is where we think the market is going to be over the next 5 to 10 trading days, maybe. It fluctuates from trade recommendation to trade recommendation. The trade recommendations that we'll be sending to our clients will include, and this is where we think the prices may wander over the next month and over the next 3 months. In addition to that, we've had a number of clients, and it's something that we've struggled with for years, on how to provide options strategies to clients. And we do that through our commodity management program, and we do that through our asset management program for significantly sized institutional investors, family offices, individual investors who are accredited investors, and fabricators, from mining companies to smelters and refiners and users of metals. They will pay us, and we will structure option strategies for them. Sometimes we actually manage the positions for them if they feel that we have a competency in managing options that they don't want to have internally. We are finding ways to offer option strategies at a lower cost basis. We can do that with accredited investors right now. We are checking on the regulations for non-accredited investors to see what the new regulations are. So we're revamping our trade recommendations to provide more value for our clients. And we're building in that options trade-off. The last thing I wanted to talk about was inflation expectations. As I said, right now, I think one of the things that you're seeing in the stronger gold and silver prices are the financial markets basically concerned about inflation. Our view is that with interest rates rising and with the Fed and other monetary authorities in other countries saying that they are going to be more aggressive in reining in inflation, our view is they will succeed. We've talked about this in the past. If you see rising interest rates, it's not the rise in interest rates that can be negative for gold and silver. What's really important is how the market perceives the increase in those interest rates. If the market says, oh, inflation is rising, and so the monetary authorities are raising interest rates, but inflation will have the upper hand and the monetary authorities will fail, then it's bullish for gold and silver. If the markets say, well, the monetary authorities are on top of this and they're going to raise interest rates and they're going to tighten their accommodative monetary policies, and maybe you'll actually see some fiscal policies, which we don't expect to see any fiscal reform this year or next year or ever in the US government. If the market thinks that the Fed can control this, then it's negative for gold and silver. Our view is that right now, the market thinks that inflation is an issue, but that as the first quarter progresses, the market will pivot. And we're seeing this, we're seeing it in the bond market already. The market will pivot away from thinking that inflation has the upper hand and thinking that the Fed can, in fact, manage to quell the monetary aspects of inflation. Inflation comes from both monetary policies and from real economic activity, supply and demand for goods and services in the world. And the Fed can't control that. Government can't control that either. Government can influence it to some extent, but to a limited extent. So there are those issues that affect inflation. And there are all those issues I talked about earlier that could push investors to buy more gold and silver. They have nothing to do with inflation, specifically the political friction that we've seen in the United States, which is probably going to get worse over the next 3 quarters, and the political friction we're seeing in other parts of the world and the global international political problems that you're seeing. So our expectations are still that inflation will quell, both because, well, for a variety of reasons. One is different monetary policy. Another one is real economic activity as we see it unfolding. And the third one is arithmetic. You know, and I've talked about this in the past. 2020 was a year of very low demand because of the economic lockdown. 2021 was a year of very strong demand, not only because of the economic recovery and the end of the lockdown around the world, but there was also this tremendous pent-up demand. So you saw in a number of aggregates, for example, US trade imports, up 20% from 2019 levels, approximately 20%. Last I looked. So you're seeing not only a strong demand increase because of the recovery and supply constraints because of things going on in the world, but you're also seeing increased demand on top of what you would expect on the recovery. That was in 2021. 2022, you're looking at somewhat slower growth in real economic activity. You're looking at the removal of some of the fiscal support programs that the United States, Europe, China, and other countries, governments provided. So you're looking at fewer inflationary pressures. You may not see prices decline, but you may not see the kinds of increases that we saw in the second quarter and in the fourth quarter of last year. Now, these are the month-to-month data. This shows you what's going on month-to-month, which is much more important. And you can see, yes, we had 0.2% in December of 2020. It got up to 0.8% in April and 0.9% in July, came back off. And that was that temporary inflationary pressures. And then it came back, 0.9% in October, 0.8% in November. And it's coming back off as of December, the last figure, a month for which we have figures. So we're paying attention to month because that tells you what's going on, not on a year-over-year basis, but what's going on now. And we're seeing, again, that kind of reduction in inflationary pressures. It'll be interesting to see what happens with the January figures when they come out in early February. A lot of people look at year-over-year numbers, and that's where they get all frightened. And they say, oh my God, you know, we're looking at 7-8% CPI, Consumer Price Index increases. And these are the highest levels since 1982, 1983. Again, look at the arithmetic. You're looking at, in 2021, you're looking at a very strong 2021 relative to 2020. As 2022 progresses, we will start looking at a modestly healthy global and US economy in 2022 relative to a overheated economy in 2021. So the percentage increases on a year-over-year basis will decline. And with them, with a lag, will investor perceptions of inflation as a problem. So we continue to view inflation as something that's going on a temporary basis. And we think that what you'll see over the course of 2022 is inflation will dissipate as an issue, and ultimately investors and financial markets in general will catch on that that's really what's going on. A few last housekeeping notes. The Prospectors and Developers of Canada this week announced that they were going to roll their annual convention from the first week of March into June. CPM Group has a silver reception at the PDAC. Because the PDAC didn't occur last year, we did a silver seminar online. And this year we were planning to do both a silver online seminar and a silver reception. We still are planning to do them, but we will be rescheduling them into June instead of the first 2 weeks of March. We also were talking about, I've been talking about an energy and metals online seminar that we were talking about doing in early February. With the silver seminar now being rolled into June, we're going to roll that energy and metals seminar into some other period of time, either late June or early March. And then there'll probably be some other changes, which will reflect changes that are going on in the markets because of the ongoing pandemic. Real research, you can buy our yearbooks, you can sign up to our retail investor program, and then you can buy our other services too if you want. That's who we are, that's what we're doing. This is Friday, have a good weekend. We'll talk to you next week.